Welcome to today's deep dive. We are looking at a really fantastic summary of J.L. Collins' book, The Simple Path to Wealth.
Yeah, it's a classic for a reason.
It really is. And our mission for you today is to basically cut through the endless noise of the financial industry. We want to extract the ultimate no-nonsense formula for long-term wealth.
And financial independence.
Right. And what I love about this source is that it skips the complex financial theory entirely. It actually started as a series of letters from a father to his teenage daughter.
Someone who, frankly, had zero interest in managing money.
Exactly.
It is a brilliant framing device.
Yeah.
I mean, he realized early on that if he made investing complicated, she would just ignore it entirely.
Yeah, so he stripped wealth building down to its absolute bare essentials. Okay, let's unpack this. We all know the personal finance basics.
Spend less than you earn.
Right, avoid high-interest credit card debt, have a solid emergency fund, you already know that. But the absolute first priority is eliminating that bad debt before you even think about aggressively investing.
Right, because true wealth isn't just about a high income. It is about achieving freedom from financial stress. Money is simply a tool.
A tool to buy your freedom. And where Collins really diverges from standard advice is his wealth accumulation strategy. He advocates dumping basically everything into a single broad market index fund.
Specifically, Vanguard's Total Stock Market Fund, or VTSAX.
Is it really that simple, though? I mean, a lot of financial advisors would aggressively argue against putting 100% of your portfolio into just one fund.
They absolutely would, and that is exactly the friction that makes his argument so compelling. What's fascinating here is the why behind that aggressive strategy.
Because VTSAX isn't just one thing.
Exactly. It is a massive basket holding essentially every publicly traded company in the U.S.
So you are inherently diversified across the entire American economy.
Right, and Collins argues that during your wealth accumulation phase, adding bonds or complex alternative assets just acts as a drag on your overall return.
You don't need a complicated portfolio.
You need psychological fortitude. These passive funds offer low fees, diversify your risk, and systematically beat actively managed funds precisely because they remove emotional decision-making.
Because holding nothing but stocks sounds terrifying when the market suddenly tanks. I think we've all felt that awful stomach drop when you check your portfolio and it's suddenly down 20% in a month.
Well, absolutely. But the real battle isn't mathematical. It is entirely emotional. Most investors trip up because they panic and sell at the exact wrong time.
Here's where it gets really interesting. The text reframes market downturns entirely. They aren't disasters.
They are incredible buying opportunities.
Right. Shares in the greatest companies in the world are essentially on sale. You just have to stay the course, ignore the financial news screaming that the sky is falling, and absolutely refuse to try and time the market.
That stoic patience is the engine that drives you to financial independence, or what he famously calls FU money.
FU money. I love that.
It is the moment where work becomes a choice, not a necessity. And the math behind this relies on saving 25 times your annual expenses.
That is the magic number.
Once you hit it, history shows you can safely withdraw about 4% of that portfolio annually in retirement. Adjusted for inflation, of course, without running out of money.
But surely that 100% stock allocation has to change when you actually hit that number and stop working right. Because retiring right as the market crashes could completely wipe you out.
Spot on. The strategy definitely has to evolve. As you approach retirement, the text suggests shifting to a wealth preservation mindset.
This is where you finally introduce bonds.
Yes, specifically a total bond market index to smooth out the volatility. And you also have to focus on tax-efficient withdrawal strategies near retirement.
Right, like pulling from standard taxable brokerage accounts first.
Exactly. That allows your tax-advantaged accounts to keep growing tax-free for as long as possible.
So what does this all mean? If we distill everything from these sources, the main takeaway is that patience and consistency will always beat complex shortcuts when building wealth.
If we connect this to the bigger picture, the entire goal of this simple path is to fundamentally transition from working for money to finally making your money work for you.
Let's leave you with this final thought to mull over on your own. Imagine you wake up tomorrow and magically hit your exact 25 times expenses number. You have total financial freedom. How would having that absolute freedom change the very first decision you make next week?